Hi, good morning, everyone. So we'll start our Monday morning webinar now. So today we have Raffles Medical, SGX, DBS, OCBC, UOB, as well as Ascendas REIT, Ascott Residence Trust, and Shiong Group. And we have an update on our Singapore Weekly. So first, we'll start off with Raffles Medical Group. So they released the results last Monday, and generally their China gestation cost is well within their guidance. So the positive this time around is that their revenue and PATMI were in line with our estimates. Their healthcare services grew 7.4% year on year, and this is what drove their revenue growth. Then this is also boosted by their group's expansion of their insurers as well as their corporate client base. And as for hospital services, it grew 3%, and this is mainly due to growth in local patient volume, whereas foreign patient loads still remain flat. So for Raffles, interim ordinary dividend is maintained unchanged at 0.5 Singapore cents per share. So for the negative for the next 1 to 2 to 3 years, based on how fast the ramp up in the two China hospital goes, is that their PATMI and their EBITDA margins will be weighed down due to gestation costs. So for this quarter, PATMI fell 16%, but if you were to take out the China gestation cost, it would have risen by 9%. And for Chongqing's hospital, second quarter EBITDA loss is 2.3 million, and this is their second quarter of operations. So this is within expectations. However, management guided that marketing costs for the China hospitals will be increasing, and this is because of the ramp-up period to attract more customers and patients in China. However, operating costs so far in China has been lower than expected because there's medicine there costs lesser and staff costs there is also lower as well. So this gives them scope for price discounts to attract patients or even greater margins in the next few quarters. So overall, management still maintain the EBITDA loss guidance. So it's around 8 to 10 million the first year, 4 to 5 million the second year, and third year is expected to break even. So this applies for both Chongqing as well as Shanghai Hospital. So for Chongqing, it has already started operations, and this is the second quarter of operation. So if we were to total up the first half of 2019, the EBITDA loss is 4.1 million, and this is lower. This is at the lower end of the management's full year guidance of 8 to 10 million. And the hospital so far has been operating 150 beds, and it has the potential to be a 700-bed hospital in the future as it continues to ramp up. And for Raffles Hospital Shanghai is expected to commence in January 2020, and it has the potential to be a 400-bed tertiary hospital. So for Raffles Medical, we maintain neutral at an unchanged target price of $1.09. And moving on to SGX, it released its results last Wednesday. So their record derivatives performance cushioned the continuous slowdown in equities business. So for SGX, the positive this time around is that the 4Q19 net profit was up 24% year on year, and this is above our forecast. And this was mainly due to derivatives growth. So volume surged 33%, and it's mainly contributed by a China A50, MSCI Taiwan, as well as the iron ore derivatives futures contracts. And we expect market volatility to be favorable for derivatives in the future, which also will drag on to FY20 as well. And for the collateral management income, it grew 76% year on year, and this is a result of higher margin balances on the back of their open interest, as well as strong insti demand for derivatives contracts. And there's also growth in post-trade services, but it was offset by contraction in issuer services. So for their operating expenses, the OPEX line, staff cost is seasonally higher in 4Q, and headcount rose by 4% year on year. However, full year OPEX of 449 million hit the lower end of the guidance between 445 million to 455 million. And moving on to FY20, the OPEX guidance increased because there's increased headcount, larger depreciation expense from the new systems that they launched in FY19, as well as higher royalties and fees that correlates with higher derivatives volume as well. So for the negative for SGX, SDAV remains soft. It fell 14% year on year as investors are increasingly risk off. And full year dividends per share is 30 cents per share. This is 5% lower than our expectations. So DPS of 30 cents per share, it's it's around a payout ratio of 82%, as compared to last year it was 88%. So this is slight negative. An update on the SGX and NSE arbitration. So management put forth that they're optimistic that the joint proposal will be supported by the relevant authorities, and no timeline is given at this moment, and we await further news. So we are still positive that SGX strength in a diversified product suite will support the derivatives volume growth and open interest in 2020. And market volatility has proven to be favorable so far, and the strength in derivatives will offset weaknesses in equities. So we maintain SGX that accumulate at the unchanged target price of $8.09. And moving on to DBS, DBS released the results last Monday. And for them, the positive is the 2Q 19 revenue PATMI grew 16 and 20%, and this exceeded our estimates. So this is mainly due to the stronger than expected second quarter net interest margin of 1.91. So to compare to first quarter was 1.88. So it grew 3 basis points quarter on quarter. And to compare against the last year full year net interest margin, last year was 1.85. So if we recall, management actually guided that FY19's full year will be 1.9. So with a very strong second quarter net interest margin of 1.91, which is higher than the full year expectations, we expect that second quarter's net interest margin has already reached its peak, and it will probably contract from the third quarter onwards. And DBS also guided that for every 25 basis points Fed rate cut, net interest margin might contract 1 to 2 basis points for each rate cut. So as a result of the Fed rate cuts, we lower our net interest margin forecast for FY19 and 20 to 1.89 and 1.88 respectively. And for DBS, quarterly dividend of 30 cents per share is declared. This is unchanged from FY19 full year dividend. And for the negative for DBS is that loans growth slowed to 4%. And this is underpinned by increase in non-trade corporate loans, offset by the continuous decline that we are seeing in the mortgage market. So this is basically due to the property cooling measures since July last year. And also for DBS this quarter, there was a rise in general provisions for about a net increase of 57 million quarter on quarter. So this is mainly due to the ECL model, where they reflect a heightened economic uncertainty and trade war tensions. So as a whole, there's no specific reason or specific sector for the rise in GP, just that it's to reflect macro conditions. So DBS has also mentioned that there's potential upside in the next year or so to sharpen its cumulative allowance, because it has been ultra conservative in its provisioning. So that might provide some upside in the next few quarters with lower allowances, as well as possible recoveries. So for OCBC, released its results last Friday. So the positive is that their net interest margin expansion was really strong, 12 basis points year on year, 3 basis points quarter on quarter. And this has already been reiterated by the OCBC, that in the whole of FY18, they did not really reprice their loans much because they want to give the customers stability in interest rates. So in FY19, since first quarter, they have started to reprice their loans, and they caught up in their loan repricing, and as well as better utilization of the deposits. So their net interest margin grew 12 bips to 1.79. And also higher interest rates in Singapore and Hong Kong helped as well. And for wealth management, fees rebounded 17%, and this is the highest in 5 quarters. And Bank of Singapore's AUM grew 9% year on year to a new high at 151 billion. So with a higher base of assets under management, it provides a more growth in recurring fee income from wealth management. And for OCBC, positive is that they increased their interim dividend by 25% to 25 cents per share, higher than 20 cents per share a year ago. And CET1 ratio rose strongly as well to 14.4%. So the scrip dividend scheme applies to OCBC this quarter. And a negative for OCBC is that their new non-performing loans formation rose by 11%. And this was mainly due to Indonesia's crude palm oil sector. And this is because of the fall in palm oil prices. So certain companies under its portfolio has to be, the loans had to be restructured. And due to loan restructuring, a certain portion of it has been classified as non-performing loans. So to put things into color, the CPO exposure is 2% of loan book. However, OCBC is not too worried right now because their collateral value is more than enough to take care of this non-performing loan provision. And for OCBC, there's this life insurance business from Great Eastern. So the contribution fell 26% year on year, but this is mainly due to a decline in the discount rate they used to value their long-term insurance contract liabilities. So this will flow straight to the P&L, and this was a little bit offset by better investment performance. However, the underlying business of the insurance business is still healthy. And UOB also released the results last Friday. The positive this time round is that the loans surprised us on the upside by rising quite strongly at 9% year on year, despite weaker loans growth in Singapore. And this is mainly due to the regional franchise in Southeast Asia, which helped their loans growth as well. And fee income rebounded 6% year on year after 2 quarters of contraction. And the fee rebounded due to strong recurring wealth management fees, credit card fees, and loan-related fees. So similarly for UOB, the AUM rose 9% and reached 118 billion. And this is mainly due to rising affluence across Southeast Asia and the Southeast Asia franchise. So 60% of UOB's AUM actually originates overseas. And allowances fell this quarter, 44% down, due to write-backs in allowances on GP assets. So NPL ratio is healthy, 1.5. Last year was 1.7. And UOB similarly declared a higher dividend, 55 cents per share. Last year was 50 cents per share. And the negative for UOB is that net interest margin fell. So the reason why it fell is because they have a higher cost of funding due to growth in fixed deposits year on year. However, UOB has been trying to release the excess fixed deposits on a quarterly basis. That's why you see the net interest margin expanded on a quarterly basis, although it contracted year on year. So other than them releasing their fixed deposits on a quarterly basis, they also repriced their loans with higher interest rates in Singapore and Hong Kong as well. So for the second half 2019, UOB guided that the net interest margin will be similar to first half 19 because it has a blended effect of them continuously repricing their loans as well as better cost management as they continue to release excess fixies. So this is the banking results wrap for second quarter. So I put some of the main data from DBS, UOB, and OCBC. So for net interest margin, DBS still performs the best because it has the largest CASA base. And in terms of growth, OCBC grew 12 basis points year on year, and this was the highest among the 3 banks because of their lagged loan repricing that they did in 2019 after compressing loan rates for the whole of 2018. And for net interest income, all 3 banks did well. They benefited from higher interest rates in Singapore and Hong Kong. And as for fees income, all 3 banks also enjoyed quite good growth in fees income, mainly from wealth management, credit card, and loan-related fees. Although OCBC only saw 1% growth year on year, and this is mainly due to their Great Eastern arm. And as for loans growth, UOB did the best, 9% year on year, despite slowdown in Singapore, and this is mainly contributed by the Southeast Asia franchise. And as for housing loan, DBS was flat. However, they maintained, even though it's flat loans growth, they maintained their market share at 31%. OCBC actually contracted in housing loans growth by 5%, and this is a consecutive quarter of contraction for OCBC. So housing loans, DBS is the highest market share, and for NPL, still stable for all 3 banks at 1.5%. Asset quality is stable, no particular sector is seeing any deterioration. Allowances for DBS grew because of the buffering up of GPs due to macroeconomic condition changes, and they adjusted the ECL model. And for OCBC, it grew by 429%, and this is mainly due to the crude palm oil sector that had loan restructurings due to the fall in palm oil prices. So UOB, the allowances is lower this quarter is because of general provision write-backs, which is not a consistent thing. So this is probably a one-off thing. So new NPA formation highest for OCBC because of the crude palm oil sector. CASA ratio, DBS remains the best, 59%, and has the lowest cost of funds amongst the three banks, which reflects in their strongest net interest margin. And for CASA, interesting thing to note is that UOB's CASA actually grew 4% year on year, and this will aid their net interest margin in the next few quarters. And fixed Ds, all three banks are trying to reduce the excess fixed deposits that they have gathered because of falling interest rates right now, and they need to better manage the costs. And LDR ratio remains stable. Usually banks aim for between 85 to 90% in Singapore. So CIR ratio, DBS managed the cost most efficiently this quarter. And CET ratio remains robust. OCBC CET1 shot up to 14.4%. And this gives them scope to weather uncertainties as well as potential inorganic expansions or acquisitions. So next I'll move on to Natalie for Ascott Residence Trust.
Hi, so Ascott released their 2Q results last week. On the revenue front, they did better despite the softer economic outlook. Revenue increased by 1.5%. This was due to better performance in Philippines, which is the asset that recently underwent some AEI, and this helped to boost their RevPAR as well as revenue and gross profit. The gross profit increased by 6.8%. However, this was mainly due to the adoption of IFRS 116 leases, so it's an accounting adjustment, excluding which the gross profit actually fell by 1% year on year. On the same store basis, excluding the IFRS 116, gross profit actually increased by 0.2%. This is because they divested Ascott Raffles Place and acquired Citadines Connect Sydney Airport, which actually was a lower grossing asset compared to Ascott Raffles Place. So excluding those transactions, gross profit actually increased by 0.2 million. Distributable income and DPS were up. This was due to the payout of realized exchange gains on the early repayment on foreign exchange loans. They repaid the foreign exchange loans from the divestment proceeds of Ascott Raffles Place. So excluding the payout from FX gains, the DPS growth was actually flat. On the positive side, as I mentioned, the diversified portfolio delivered a 1.5% increase in revenue. This is actually one of our investment theses for Ascott, the diversification of geographies as well as lease structures. And this helped them keep their earnings stable. So the higher revenues, looking at their key markets, the higher revenues from UK and Japan, which was actually event-driven demand, offset the weaker performance due to heightened competition in Australia, namely Melbourne, and China in the Tier 2 cities. The prudent hedging strategy also shielded ART from FX fluctuations, and it kept the impact to about negative 0.2% of gross profit. As I mentioned, Philippines, the asset that just underwent AEI, it has helped to increase the RevPAR by 18%, and this translated into 18% and 54% revenue and gross profit growth respectively. So, on the negative side, the sluggish demand in Melbourne saw the RevPAR falling by 4%. And this asset in Melbourne accounts for about 4.7% of NPI. Looking ahead, we actually note that there's a temporary deviation in their targeted 50-50 growth stable revenue structure. So the growth, this structure is the lease structure. So the growth, the stable revenue comes from master leases as well as management contracts with minimum guaranteed income, which is a floor. Basically, it's a floor, and the growth comes from the management contracts. So Ascott actually targeted a 50-50% split between these two quarters. We also expect a higher revenues from the asset in US, New York, which is Element New York Times Square, as well as the asset in Jakarta. This is due to the post AEI works, and we should see the uplift in the following quarter, which is 3Q. Due to the divestment of Ascott Raffles Place and the repayment of loans, the gearing actually fell by 2.9 percentage points to 32.8%, and this helped to increase the debt headroom from 880 million to 1.1 billion. And also, I'd like to point out that Ascott has a relatively low cost of funding at 2.3%. Another thing is Ascott has two tranches of perpetual securities that are callable in October as well as in June. So October 2019 and June 2020. These two tranche of perps are paying 5% and 4.68% coupon respectively. And given the low interest rate environment, it is very likely that they will be called and refinanced. So the pie chart on the right actually shows the breakdown of revenue from stable and growth sources. Yeah. So as I mentioned, they are actually targeting a 50-50 split. To wrap things up, our call for Ascott is accumulate with an unchanged target price of $1.36. So moving on to Ascendas REIT, the gross revenue for A-REIT increased by 6.1%, but this is due to the contributions from their recent acquisitions, namely the two UK logistics portfolios that were acquired in August and October of 2018, as well as 3 Australian properties that were acquired. On the positive side, we note that the Singapore operations actually recorded an improvement in occupancy, a very slight one, 0.6 percentage points, as well as positive rental reversions of 2.7%. This is despite the management guiding for flattish rental reversions for the last 2 quarters. Previous quarter, which is the 4Q 2018, the rental reversions was actually 6.6%. Some of the new leases that were signed was driven by the transport and storage sector, and it accounts for 28.9% of the new leases signed by GRI. So the electronic sector has been flagged as one of the weaker performing or worst performing trade sectors, with the non-oil domestic exports actually falling by about 30% in May and June for year on year. However, we note that what we feel that works in A-REIT's advantage is that they have a very large customer base of 1,350 tenants, of which the electronic sector only accounts for 6.4%. On the negative side, portfolio occupancy actually declined by 80 basis points to 91.1%. This was because of temporary lower occupancy in Australia due to non-renewals. A quick update on that, is the largest asset that was vacant, which is 49 Lenoir. It has been fully leased out, and the lease starts in July. Another thing to note is the SG portfolio occupancy is actually below the industry average, so of 89.3%, despite improvements in occupancy. However, the industry average is actually boosted by the large number of single tenant assets versus A-REIT's portfolio. So A-REIT has less single tenants and more multi-tenants, and that is partly why the occupancy for Singapore is actually slightly lower than the industry average. So looking forward, it's not all doom and gloom. It's not as grim as it appears. For A-REIT, they have 9.3% of GRI that is actually expiring in FY19. So it's considerably a very low proportion of GRI that's expiring. And the supply that is coming on in 2019 represents 1.6% of the total stock, or total industrial stock, of which 90% is already pre-committed. So this should help to provide industrial rents some support amidst the softer economic outlook. On the right side, this is the breakdown of A-REIT's MPI sourced by different industrial subtypes. So the largest one the two largest sectors is actually the business park as well as the high-tech, high-spec. These two asset classes are the ones that have most demand for, and we note that A-REIT is actually also trying to reposition out of the light industrial properties, which is the green pie over here, and try to reposition into high-spec, high-tech. So they recently divested one of the assets in Singapore at a 14% premium to market value. That is the asset in a light industrial asset, I mean. Also, last quarter, they announced that they will be repositioning two assets, 25 and 27 UOB Road assets, into high-spec, from light to high-spec. So we actually increased our target price to $3.31. This is due to the lowering of our risk-free rate, as well as higher revenues from the persistent signing of above-market rents. And with that, I move on to Paul for Sheng.
Thanks, Nelly. Paul, we'll move on to Sheng Siong's second quarter results. The results was positive. Firstly, the revenue grew around almost 12%. Net profit was a slower 7%, but because there was a change in the accounting standard, namely the lease accounting, if you adjust for that, I think the earnings would have been up almost 12%. In terms of what was positive about the news, or what was driving the growth has been the 10 new stores that they opened last year. And also what is positive is that they'll be bidding for 6 new stores. They've already submitted their bids. And there's 4 more online stores available for bidding. And also there could be some private deals, as some stores such as Giant may have closed down, and there could be some private deals to take over these stores. So the positives would be, firstly, Sheng Siong growing at almost 12%. Is almost 10 times faster than the industry. The industry is contracting roughly around 1%, whereas Sheng Siong is growing 12%. The second positive is that, as you know, the growth this year has been because of the record 10 new stores last year. So this year you could see a similar increase. In the first half, they've already secured three new stores. So this year, there's a high chance that they could actually come close to the 10 new stores that they had last year. The other positive is that gross margins did rise. There's an uptick of 0.1, but it was a bit held back by some raw material costs, namely pork prices was actually higher than expected. But they're not passing everything on to their customers. So that has been higher raw materials has been one of the reasons why the gross margins could have been higher, because the contribution from fresh is actually higher than before. And in terms of the negatives, the obvious is that as you open new stores, it takes time to gain the operating leverage. As you know, new stores will require new staff, utilities, and so forth before the sales start to come in. So you have to pick up this upfront expenses. As you can see, the operating costs, at least admin expenses to sales, is about 18%. But on a steady state, they are about 16.5. So you can get at least another one, or almost 1 to 1.5 percentage points kind of creep up if the operating leverage starts to come in. So operating leverage is probably the story for Sheng Siong in 2020, as maybe sales might taper down a bit, but you get the operating leverage in terms of the faster than sales growth in terms of EBITDA and margins, operating margins. The other negative was that although same-store sales improved, it was down negative 1%. Last year it was up about, it's still down 0.3%, at least for the second quarter. I do take note that they're actually still taking market share. In the first half, their same-store sales was down 0.6%. But if you compare some of the same-store sales for supermarkets in malls, using CMT as a proxy, they're also taking share from, obviously, market share from some of the malls, the supermarket sales in the malls. In terms of the outlook is positive. I think there are multiple drivers for the next 2 years. Market share gains, as mentioned earlier, store expansion last year and this year, improved productivity per store. I'm not shown in the slide, but they are, because these are still new stores, so in terms of the revenue per square feet, it's still below some of the other stores. So there is also upside. And of course, operating leverage. We downgraded to accumulate, mainly because of the rally in the share price. So we still like it because of the stable growth and the active metrics and so forth. Okay, this is just the last section. Move on to our weekly views. In terms of macro, the only thing for out of Singapore was, of course, the loans growth for the industry is flattening out, and we've finally seen some crack in the SIBOR when Trump announced his tariff cuts, tariff increase. I think we did see SIBOR started to dip more significantly. In terms of US, I think there was a bounce in the PMI and then job growth was healthy. In terms of the global macro picture, I think the global PMI still declined, especially due to Europe, but we did see some modest rebound in the PMIs for China and US. And of course, with the Trump cuts, I think we're getting with expectations now at least 3 rate cuts in 2019 and another 2 in 2020. In terms of the theme, I think obviously the theme now is the interest rate trade. I think global bond yields will be headed for all-time lows. And you look at the US yields themselves, they are I wouldn't say close, but at least they are 50 points just above, probably not below, just above their all-time lows in 2016. So really seen globally, some countries like especially in Europe, their global bond yields are record lows. So although global growth is stalling, but we could get some repricing of all assets to the new risk-free rate kind of benchmarks. Most attractive for us right now, thematically at least, actually will be, interestingly, will be those SGX listed US REITs. I think what we see, they enjoy superior yields, about 6 to 7%, and also they have the US dollar currency. The US dollar looks strong, especially against the Sing dollar, on the relative growth, and also, MAS in October most likely will ease on their monetary and their exchange rate policy. And of course, there's a bit of a regional currency risk, especially if the RMB crosses $7. That could put some pressure on all regional currencies. Of course, SGX is also another beneficiary. What we've seen is the spike in VIX and also the currency volatility, especially in the emerging market. So that should also benefit the SGX. In terms of the tariffs, I think the obvious is that basically Donald Trump just wants his 3 rate cuts from the Fed. Unlikely to see any relaxation or so-called Mexican U-turn on the tariffs until we see more US signs of slowdown. There is no pressure point for Trump right now, apart from the farm incomes, but he's giving a lot of subsidies to the US farmers, so that is kind of placating. So until we see some major US slowdown or some deterioration in the US equity, unlikely to see this tariffs kind of U-turn. In terms of the weeks ahead, I think this week we're probably going to see five central banks in Asia make a decision. Probably out of the 5, probably 3 central banks in Asia probably cut rates. So the whole interest rate theme will be the whole trade or synchronized cut in interest rates will be the theme, at least for the near term. Okay, the next one will be probably there's a Jackson Hole meeting by the Federal Reserve Chairman in 22nd, 24 August. That will probably be the next indication of what his view on interest rates. Nothing much. This is just some of the charts. Actually, what was beginning to get positive was that we were beginning to see some rebound in some of the ISM new orders for the US and even for emerging markets, especially China. We're starting to see some modest improvement, but I think with the tariffs, we're probably going to see this downshift again. The weakness is, of course, although consumers are holding well, even before the tariffs, the US corporate spending has really been kind of deteriorating. And these are the rate cuts expected. Now it's already taken a new low. We're probably looking at another 2 rate cuts this year. Okay, in terms of our Phillip Absolute 10, we will help this in July by APAC Realty and Siong and some of the banks. What dragged was namely Singtel, but I think that's because of the event X dividend, that was the one that hurt our portfolio. Anyway, this is just an illustration of our performance for this year. Okay, I'll move on to question and answers. Yeah, any questions, please post them. Thank you.
We have a question of how the current target price for DBS of $27.60 was calculated. So we use the Gordon Growth model. So our target price is based on a target price to book of 1.4 times. And our long-term ROE assumption is 12.5% and cost of equity 9.3 with beta of 1.2 and growth of 2. So previously our growth rate was 2.5, so we lower it to 2%. And you can find our target price calculation data on the back page of our report, and you can refer it for the change in matrix as well every quarter.
Okay, thank you. Just one question we have is, with the possibility of a full-blown trade war coming, do you think investors should adopt Fed to safety methodology or any counters? I guess in terms of the Singapore context, the so-called flight to safety stocks, or will be the so-called bond proxies. So these bond proxies, the one that sticks out, of course, will be Netlink Plus. The rest will be all the Singapore REITs. But because most of these Singapore REITs have run up quite a bit, I think that's why the one that looks comparatively more attractive will be the US listed REITs. I mean the SGX listed US REITs. I think those look quite attractive because their yields are almost 6 to almost 7%. And again, I think in the near term, I think against the Sing dollar, I think the US dollar looks compelling. The story for stronger US dollar looks compelling against the Sing dollar. So they should that should be one place that we think thematically, at least we don't cover. The problem is we don't cover this US REIT, but thematically, I think that will be attractive.
Hi, since there are no other questions, we will end the webinar here today. Thank you for joining.